Now, this is the deal that I wish every investor knew about. 393,000 total project, 41K out of pocket, one loan and one closing. This is the deal that an investor friend of mine just closed on. It was a fix and flip in Tennessee. We bought the house, funded the entire renovation, all in one transaction. And the thing is that most newer investors do this with two separate loans, one to buy the house and one to pay for the renovations. Two applications, two sets of closing costs, and two timelines to manage. But there's a smarter way, and I'm here to show you how it works. My name is Ricardo Carrillo with RC Lending Advisors. We run a nationwide mortgage lending team that covers all 50 states, and this one is for my real estate investors that are watching. So let's break this deal down. This was a repeat client of mine who's a serial real estate investor, bought multiple properties. He loves to buy distressed properties, fixes them up, and then ends up selling them for a profit or sometimes even keeps them to rent them out. Typical fix and flip operator. He doesn't borrow in his own name, borrows directly through an LLC. And this is just the business setup that protects his personal assets in case something actually goes wrong with the deal. He personally guarantees the loan, though, which is a requirement of the lender. In case the deal blows up, he's still on the hook, but underwriting is actually completely different on these kinds of loan programs than it is on a regular home loan. With a regular loan, you have to bring W-2s, you got to bring tax returns, you have a debt to income ratio that the bank's calculating. None of that matters here because the only thing that the bank cares about are these three things. How much experience do you have? What is the house going to be worth when you're done with renovations? And what's your plan to get out of the house? Now, the house was a beat up single family home in Knoxville, Tennessee. Purchase price was $313,000. Here's what makes the loan different though. There's two pieces to it because they both got funded at the same exact time. Now, the first piece was the purchase money for the actual house. $282,000 was the loan. That's what the bank gave him to buy the property. The second piece, something called a construction holdback, $80,000. That was the renovation budget. Here's the thing though. The bank's not going to give my client the 80 grand all on day one. They're going to hold it back. That's where the name comes from. And then they're going to release it in pieces as the work gets done. The cool part is that my client's also doing all the work on the house. That left a total loan of around $360K, and the loan term's only 12 months. It's interest only, meaning he doesn't have to pay down the loan every single month. It's just the interest that's accrued. And so it's actually a lower monthly payment. And then when the 12 months are up, he has to pay the entire thing off in one big payment called a balloon payment. That's why these programs are called bridge loans or fix and flip loans. They bridge the gap between the buyer buying the property and then selling it or refinancing it into a long-term loan. My client only brought $41,626 to the closing table and the bank funded everything else. Let's put that into a perspective, okay? Because the purchase price was $313K and then the renovation budget of 80 grand. And so it left a total project buying, fixing the house right around $390K. From that, he brought in 41 grand of his own cash, pretty much 10% to close. It's the power of a really well-built bridge loan. Also having good relationships with people like us. He's not draining his bank account buying the property with a 30% down payment and then scrambling to go get a renovation loan. It's one loan, one closing, and the deal was fully funded from day one, so construction can start immediately. Now, here's the part that typically will trip up a new investor. The $80,000 is renovation money, does not sit in his bank account waiting to be used. It sits with the bank, right? So here's how it actually works because you have to do a phase of work. Let's say you finished the demo, you finished the kitchen, you finished plumbing, and then you're going to submit a request to the bank for that chunk of money. The bank has to send somebody out to the property to verify some inspector, got to make sure the work's good to go. And then once it's verified, they're going to release the money back to you in something called a draw. Now, here's the catch. Banks are only going to release up to 90% of the renovation money in draws. The client has to cover the first 10% himself. This is how banks make sure that you, as a buyer, have skin in the game and that the work's actually going to get done. So what does this really mean for you in practice? You can't pay contractors before the work is done. The work has to happen first, and then the bank pays you, and then you go pay the contractor, right? So you have to have cash on hand first to pay the contractor while you're waiting for draws, typically, or you get a contractor who's willing to work with you. Typically, that's things like working capital. You can use it, business funding and whatnot. And if you're getting into a fix and flip loan and you think the bank's going to fund every single dollar before you spend it, you're going to have a bad time because those programs don't exist anymore. Now, let me explain why doing this with one loan is actually such a big deal, because the old way of doing this, And a lot of the way that the beginner investors that I see do this is they go get a regular loan to buy the house, if they can, of course. They close on it, and then they're going to go apply for a second loan or like a home equity line or business funding or 0% interest credit cards, multiple applications, multiple closing costs, multiple underwriting, different timelines. It's really just, it does not make sense when it comes to doing a fix and flip deal. And on a deal where you only have 12 months to renovate and then get out, you really can't afford to waste 2 months trying to get another loan approved when you have no idea how to even get started, right? You still have so many other things that need to happen. So with this kind of loan, it's like a fix and flip renovation project loan. It's one application, one closing, one set of fees. The renovation budget's already tied into the original loan. And then you walk out of closing with the property and the renovation money tied up, ready to hit the ground running. Now, let me clear something up though, because there is a pretty big important difference here. When you buy a house to live in, the bank has to follow a bunch of consumer protection rules. They got to send you paperwork for it. They have to send you an official loan estimate. They have to wait 3 days before you can even close. They got to look at your W-2s. They got to look at your tax returns. They got to look at your debt to income ratio or your DTI. And so those rules come from something that was created a long time ago called TRID, which is a federal law that protects consumers when they're getting a mortgage. But the thing is that none of that applies here because this is a true business loan. You're borrowing through an LLC for business purposes. You're going to flip the house for a profit. So consumer rules don't apply here. This is why the program has different restrictions. The banks really only care about a couple of different things. They want to know how much experience do you have in flipping houses? How many properties do you own and have you owned in the last 3 years? Is the house going to be worth it when you're done with the renovations? And then how do you plan to pay back the loan? Because on every loan, of course, the bank wants to know how you're going to repay them, right? And in this case, most banks want to know, are you going to refinance out? Or are you going to, pay the loan at closing yourself in cash? Are you going to sell it? And so there's a lot of different options and ways that you can push this. You can go the classic fix and flip route. We could do a delayed financing renovation project, which is a different strategy. So there's a lot of ways that people go around this. You can refinance it into a long-term loan, hold it and keep it as an Airbnb, keep it as a long-term rental. You have a lot of flexibility because once the house is already done and the renovation's been completed, you can do really whatever you like. If you want to hold it a little bit longer because the market's a little in shambles, there's different ways, different things that have happened. And you can refinance this also into different loan programs, things like DSCR loans, conventional loans, non-conventional loans. You can refinance it into any loan program that you'd qualify for. My team and I have done this for so many people. Another option is to do a 1031 exchange, right? This is a tax move. You sell the house, you take that money, put it into another investment property within a certain time window. You won't have to pay the taxes on capital gains, on the profits. So there's plenty of opportunities here that people utilize in order to try to scale their portfolios, because all at the end of the day is just being creative. Now, my team and I love walking our clients through those options and what makes the most sense. The loan should always be built around how you plan to exit and not the other way around. Here's a recap on the deal. It was a distressed single-family house in Knoxville, Tennessee. Purchase price was $313K. Money for the purchase was $280. Money for the renovations was $80,000. Total loan was $360. 12-month term loan, interest only, balloon payment at the end. Cash to close that my client brought to the table was $41,000, which is phenomenal. Renovation money was released in stages, so he's getting the draws. He's going to be able to finish the renovation project, and we're going to sell it when we're done. One closing and one loan, with right around 10% down to close on a fix and flip loan, which is really, this is how serious fix and flip investors do this. You have to stay liquid, and you have to stay liquid across multiple deals because it's a lot of cash heavy business. You don't want to have a lot of cash tied up in one property, and then what are you going to be doing? So if you're an investor, you want to understand how these kinds of financing works, how we've done this for other people, what locations we've done this with, who we can connect you with. We have all the resources to make this happen for you. You can go to rclending.co to find more information about my team and I. You can also follow me on Instagram at Richie the Lender for deal breakdowns just like this one that I do every single week. And if you haven't seen my other Deal of the Week videos, please make sure that you check those out either here or here. Like and subscribe to the video, and I will see you guys in the next Deal of the Week.